The financial world has just witnessed a move in the silver market that has sent shockwaves through every portfolio and challenged the core thesis of every analyst. The unthinkable happened. Silver, the metal with an unbreakable industrial floor, the cornerstone of the green energy transition, violently plunged through the critical $100 per ounce support level. The charts are shattered. Technical indicators are screaming bearish collapse. Headlines are declaring the end of the rally. But I am here to tell you that what you are seeing is not a breakdown. It is a spectacular, orchestrated shakeout, the final cleansing of weak hands before the next and most powerful leg up. This is the moment that separates paper traders from physical holders, and it is the most important moment you will face this year. Let's first acknowledge the brutal facts. The spot price flashed an intraday low of $98.47, a number that psychologically demolishes months of consolidation. The RSI is buried in oversold territory at 22. The Mech has executed a bearish death cross. The price has decisively broken below its 200-day moving average. On paper, this is a disaster. This decline did not occur in a vacuum. It was hammered by a perfect storm of macroeconomic forces. The US dollar index ripped upward in its strongest weekly gain in decades following hawkish signals from the new Fed leadership. President Trump escalated tariffs on Mexico, immediately disrupted the flow of silver byproduct from shuttered auto plants. The political noise from other headlines distracted the mainstream. Together, it was enough pressure to trigger algorithmic selling and panic liquidation. Volume exploded to 320% above its average, a classic signature of a capitulation event, where the last holders finally give up and sell. But now, you must look away from the flickering spot price on your screen. You must look at the reality of the physical market, because there, the story is completely different. If you attempt to buy actual deliverable silver, today a 1 kilo Bartha price is not $100. It is $135 or more. Major dealers like Mech are posting sold-out notices with delivery timelines stretching 6 to 8 weeks. In Pakistan, the local premium has exploded, with physical metal commanding a price nearly 50% above the quoted spot. This is the great disconnect. The paper market, a world of digits and derivatives, is in panic. The physical market, a world of tangible bars and industrial necessity, is screaming shortage. One of these realities is an illusion. The other is about to enforce its rules. The foundation of this disconnect is not speculative. It is mathematical and structural. The demand profile for silver has undergone a fundamental, irreversible shift since 2020. Solar panel manufacturing is now a monolithic consumer, absorbing hundreds of millions of ounces annually as global energy mandates accelerate. Electric vehicle batteries require silver. There is no commercially viable substitute for its unique properties in conductive pastes and busbars. Emerging technologies like AI data centers are adopting silver-based cooling systems. This is consumption that did not exist at this scale a decade ago. On the supply side, the picture is bleak. Primary mine supply has been flat for years. No major new mines are coming online before 2032. Recycling can only cover a fraction of the gap. And now, geopolitical decisions are actively dismantling supply chains. Mexico, a top 3 global producer, is diverting its silver output domestically. Canadian byproduct flows are being pinched off. The result is a structural deficit measured in hundreds of millions of ounces SA, deficit that grows each year. This current plunge is a historical echo, not an anomaly. Let's look back. In 2011, after its famous near $50 peak, silver endured a brutal 47% retracement. That was not the end. It was the violent reset before the next major advance. During the 2008 financial crisis, silver was crushed by 54%, only to become the foundation for a multi-year bull run that took it to historic highs. These shakeouts share identical hallmarks: extreme oversold conditions, a break of key technical levels that triggers mass stop losses, and a simultaneous, quiet strength in the physical market where premiums begin to detach. We are seeing that playbook execute in real time right now. The paper system underpinning the spot price is now stretched to its breaking point. On the COMEX, the crucial trading hub, the latest data shows a staggering 6.5 paper claims for every single ounce of registered, deliverable silver in the vaults. This is not a stable ratio. This is a fuse. Projections for delivery notices in February threaten to claim nearly all of the remaining available ounces. The system is facing a simple mathematical impossibility. It cannot deliver the physical metal that the paper contracts promise. This does not resolve with a gentle decline. It resolves with a violent repricing where the paper price is forced to chase the physical reality. So, what is your move in this moment of maximum fear and confusion? Your strategy must be built on the immutable physical truth, not the volatile paper narrative. Your absolute, non-negotiable priority must be acquiring physical silver. This means American Silver Eagles, Canadian Maple Leafs, 1-ounce rounds from the most reputable dealers. You are not buying a ticker symbol or taking direct, sovereign possession of the tangible industrial commodity that the world desperately needs. You must avoid the paper ETFs like GLD or SLV. These are financial instruments fraught with counterparty risk, precisely when that risk is peaking. They are bets on a paper price, not claims on the physical metal that is in short supply. Simultaneously, recognize the asymmetric opportunity in the mining sector. Companies like Hecla Mining and Core Mining, with substantial U.S.-based production, are no longer merely equities. In an era of reshoring and fractured global trade, they transform into strategic national assets. Their operational leverage means that a recovery in the real price of silver, the physical market, dictates will amplify their gains exponentially. You must also understand the powerful signal flashing from the silver-to-gold ratio. It is now blown out to an extraordinary 103 ounces of silver to buy 1 ounce of gold. Throughout history, extremes in this ratio have marked major inflection points, almost always followed by a massive outperformance of silver. This is not a subtle indicator. It is a klaxon sounding a generational accumulation signal. We are witnessing the narrative split in two. On one path are the paper traders glued to their screens, reacting to algorithms and headlines, selling on fear into a liquidity vacuum. On the other path are the physical holders and the industrial consumers, operating in a reality where price is defined by availability and need, not fleeting sentiment. The solar panel factory does not cancel its orders because the spot price dipped on the COMEX. It secures its supply at whatever premium is necessary to keep its lines running. That is the unbreakable floor. This volatility beneath $100 is the sound of the old, over-leveraged paper regime gasping its last breaths. The physical reality is preparing for a monumental and inevitable reset. Your task is not to be shaken out by the noise. Your task is to recognize this moment for what it is: the final, most painful pullback before the underlying structural realities assert their total control over the price. This is the time to stack with discipline, with conviction, and with clarity on the bedrock truths. The industrial world cannot function without this metal. And that demand creates a floor from which the next explosion will launch. Do not watch the trap spring. Position yourself on the right side of it.